Last time we took a close look at Optex Systems Holdings, OPSX. Today we're shifting gears to Safe Pro Group, Inc., that's SPAI, a company making waves in the industrials, aerospace, and defense. They're really centered on AI, drone tech, and specialized protection products.
Yeah, it's definitely a hot sector. Lots of excitement, lots of buzzwords. But sometimes the fundamentals, they seem to get a bit lost in the shuffle.
And that right there is the core issue, isn't it? The central question for SPAI. Does its, let's call it overwhelming strategic momentum, the high insider conviction, the real technological leadership in AI defense, does that justify this premium valuation? Or are we looking at severe negative margins, an extremely high price-to-sales ratio that just scream unsustainable, speculation-driven bubble? So I'll be arguing that the premium is warranted, reflecting genuine growth catalysts and, frankly, non-linear future potential.
And I'll be arguing that the current market cap is, fundamentally detached from the financial reality on the ground today. It's a necessary challenge, I think. The gap between the story and the numbers, it's just too big to gloss over.
Okay, so my position is pretty straightforward. SPI shouldn't be viewed like a traditional defense contractor. It's more like a pure IP and software play. High growth, high conviction, focused on critical tech for national security, for humanitarian efforts, mine detection, force protection. And the market seems to agree, doesn't it? Look at the stock performance, an absolutely remarkable 181% gain last quarter, 142% over the past year. That's not just random noise. That's investors believing in where this is headed.
Okay, the rally shows enthusiasm, absolutely, but enthusiasm doesn't pay the bills. It's not cash flow.
But conviction is a telling metric. Insider ownership sits at a really substantial 60.52%. That level of internal alignment, especially when you combine it with recent catalysts, the $8 million private placement led by drone industry heavyweights, getting into the Russell Microcap Index, and these key selections by the U.S. Army Futures Command for their 2026 experiments. You put that all together, and the high valuation metrics start to make sense. They're sort of the cost of admission for a company poised to grab a huge piece of a future market, potentially billions in defense and commercial drones.
Right. I get the appeal of that story. I really do. Especially with AI and defense, it's compelling. But I have to come at it from the numbers perspective. And from that angle, current valuation, it just looks fundamentally disconnected from its financial reality. It suggests maybe extreme, maybe irrational exuberance.
Okay. Explain the detachment. Where's the disconnect for you?
Well, the core financials are frankly alarming when you just lay them out. Trailing 12-month sales, they're barely a blip, $1.5 million. But the market cap, $133.76 million. That gives you a price-to-sales ratio of, wait for it, 89.17. Astronomical. You almost never see that outside of maybe pre-revenue biotech. And then there's profitability, or rather the lack of it. A TTM income loss of nearly $11 million. And look at the margins. Gross margin is negative 372%. Operating margin, negative 726%. Just deeply negative.
I acknowledge those figures are challenging for traditional valuation models, yes.
And it gets worse when you look at the balance sheet. A price to book of 42.58? That's just excessive given the book value per share is only 17 cents and cash per share is a mere 4 cents. The market is pricing in, decades of perfect execution starting right now. And finally, that beta, 3.47, it just confirms this is a highly volatile, highly speculative stock right now, driven by news, not by fundamental strength.
Okay, let's tackle those negative margins head on, because that really is the crux of it, isn't it? You asked, how can any valuation hold up with a negative gross margin of negative 372%?
Exactly. It suggests that for every dollar of revenue they bring in, they're spending, almost $5 just to deliver the product or service. That's before you even factor in R&D or SG&A. It points to some kind of deep structural problem, or maybe just completely unsustainable pricing just to get a foot in the door. And look at the EPS growth over the last 3 to 5 years. Negative 271%.
I see why you'd focus on the loss per unit, but let me offer a different framing. These margins, they are the direct, unavoidable cost of building an IP moat in what's essentially a winner-take-all defense tech market. It's heavy, necessary investment upfront in product development, in securing the IP, like those patents protecting their AI drone imagery tech until 2043.
But aren't those typically R&D expenses? A gross margin problem usually points to cost of goods sold, right?
Precisely. And in this case, the cost of goods sold is the cost of generating and processing these incredibly specialized data sets that are their core AI product. The source material mentions they've processed over 1.6 million drone-based battlefield images. That enormous proprietary data set, that is the asset that arguably justifies the negative margin right now, because it creates a competitive barrier that's very hard for others to replicate. They're essentially buying market share through data dominance.
That's an interesting perspective, though I'd still question how long they can sustain that kind of investment burn.
Well, it seems they are sustaining it, and it's starting to translate to the top line. There was strategic news reporting, surging FY 2024 revenue growth 136%, potentially getting past $2 million. This really suggests that the 1.5 million TTM figure might be becoming outdated pretty quickly because they are executing. They're turning that investment into faster revenue growth.
Okay, growth is good, obviously, but the financial structure needs. Well, it needs an almost immediate and massive acceleration in profitable contracts, which brings us to those strategic engagements you mentioned.
Exactly. SPAI is getting deeply involved in these high-value, future-focused defense and humanitarian projects. You got the U.S. Army Futures Command collaboration, that $90,000 reported in lobbying spend, specifically targeting science and tech defense funding, the training programs they completed with the Philippines military on AI analysis and drones. These aren't just press releases. They show a clear pathway towards winning high-margin, long-term government contracts. You know, the defense sector requires lengthy testing, validation. SPAI seems to be navigating that pipeline.
It's a compelling forward-looking case, yes. But let's challenge the basic assumption here. Do these engagements guarantee cash flow? Because did you notice the data point that explicitly states no government contracts reported in the source material?
Well, the material does say they delivered explosive ordnance imagery datasets under a government-linked contract, and they completed that UN Development Program purchase order for AI minefield analysis in Ukraine. These aren't hypotheticals. They are precursors, surely.
They're important news items, absolutely. And that explains the high beta, the stock performance. But the market seems to be pricing in hundreds of millions in revenue from agencies like the U.S. Army that, based on the public data we have, just haven't materialized yet as actual awarded contracts. I'm sorry, but I just don't see how these high-profile announcements guarantee the kind of cash flow needed to plug in $11 million annual loss, especially with that explicit no government contract status. It feels like pure projection, and projection always carries risk.
Okay, if we accept the market is projecting, then the interesting question becomes why? Why is the market applying these extraordinary metrics?
Let's talk about that projection then. That PS ratio of 89.17, it's shocking, honestly. That's usually reserved for like pure software plays with near guaranteed 90% margins once they scale, or maybe pre-revenue biotech, as I said. SPAI is a complex mix of defense, services, maybe even some hardware elements. And according to that Quiver data, only 13 employees? Valued at over $133 million? The basic math just doesn't seem to work based on current output or even what looks like realistic near-term scaling.
See, I disagree with that comparison. This isn't a mature services company, and the analyst community seems to agree with me, right? They have a target price of $12.50, suggesting, 75% upside from the current 7-Eleven price? The valuation is there because the core asset is the proprietary AI software, the patented tech for threat detection. That platform is hyper-scalable. It's software, not manufacturing widgets. The strategic investment from drone industry leaders in that placement seems to confirm that view.
But the financial risk is immense. If they keep burning through nearly $11 million a year, they're constantly exposed to needing more capital, which likely means dilution for current shareholders. That's a terrible position to be in.
But look, for a company that is uniquely positioned, arguably, to capture a slice of that $30+ billion in new U.S. defense spending on AI and drones, that figure is explicitly mentioned as key here. Maybe a premium is required just to get in the game and aim for dominance. They're selling access, mission-critical access, to a very specialized, very regulated market where being the first mover could be everything.
A premium needs to be backed by a solid capital structure, though. Which brings us to maybe the final point, the risk tied up in their insider commitment and balance sheet.
And the capital structure actually offers a strong defense here. That 60.52% insider ownership, that's a powerful signal of deep internal belief and alignment. It offers some confidence, right? Plus, the balance sheet shows pretty low leverage. Debt to equity is only 0.09, and the current liquidity, current ratio 1.64, seems reasonable. It suggests they're managing this high-growth, high-loss phase without piling on excessive debt, which protects long-term value.
Okay, the debt level is low, I grant you that. But that nearly $11 million TTM loss means they need continuous, significant access to capital just to keep the lights on. And the balance sheet only shows 4 cents per share in cash. They are walking a financial tightrope, constantly needing perfectly timed capital raises.
But 60% insider ownership? Surely that speaks volumes, more than temporary cash levels.
I acknowledge the high percentage, yes, but let's look a little closer at that conviction. While the ownership percentage is high, the data also shows no recent insider trading data, no recent buys, no recent sales reported. To me, that suggests a pause in active conviction, at least at these elevated prices. If insiders genuinely believe that 75% upside was a lock, wouldn't you expect to see some open market purchases to increase their stakes? The silence at these price levels is, well, it's noteworthy. And look at institutional ownership, still relatively low at 9.02%. It kind of supports the idea that a lot of the smart money is still on the sidelines, waiting for that crucial moment when SPAI actually converts all this compelling news into real, quantifiable, profitable, recurring contracts.
Okay, so summing up my view, we've established SPAI has critical, proprietary AI technology. You've got strong insider commitment, significant recent positive stock performance driven by that future potential. The huge stock gains, that analyst target price, it all reflects the market pricing in a nonlinear, disruptive growth path, which is pretty common for these deep tech defense innovators.
And from my side, the discussion has really highlighted that the valuation remains highly speculative. It's almost entirely dependent on future catalysts, not current cash flow. That extreme PS ratio, 89.17, the massive negative margins, they show a profound disconnect between the company's actual financial output right now and its $133 million valuation. It makes it, a high-risk gamble on absolutely flawless future execution.
Yeah, I think you're right. The core tension really is bridging that gap, isn't it, between SPAI's undeniably compelling strategic news flow, the work with the U.S. Army, the UN, the Philippines, and the stark reality of its current lack of profitability shown in those TTM financials.
Exactly.